Okay, let's answer some questions from the last market outlook. Um, there aren't that many market related questions, and I don't know if that's because I'm only selecting a few each week, but I certainly hope the questions will return. This one here is a pretty good one. Just curious, why would PIMCO ditch longer duration with rates coming down? Well, rates are coming down at the short end. And these are rates over here, right? If we break the curve down into money market and capital market, these are rates, these are yields. We say these are rates because these are all zero coupon. These are yields because these are coupon bonds. Rates are coming down, but yields are not. Yields have not been coming down since end of September. Yields have been going up. They can ride the curve. That is a very specific thing when we say ride the curve. That is a strategy for when you expect a static yield curve, is you would ride the curve. So this is how that works. Let's say that we have, and I'm just going to draw out a yield curve like this just because we're just making a point, right? And if you're buying a 10-year bond, and let's say it's a par bond, there's your 10-year, and this would be your yield that you would get. If you expect a static yield curve, in 9 years, the bond would be here. Now, if this were a par bond and this were the yield, this bond would be trading for 100. At 9 years, you're rolling down the curve, right? So that the yield would be priced here, but you have a yield that's here, so now you'd have a premium bond. It would be greater than 100. So you'd get the yield, plus you'd get the capital appreciation. I don't think we're expecting a static yield curve on this one, so I don't know that we would say that this is what we're doing. The other thing in riding the curve is you make the most if you have a curve that looks like this, right? For riding the curve, you'll do the best on the steepest part of the curve as long as you have duration. So you're usually somewhere between the 5 and the 10 for doing that kind of thing. They're selling low and buying high. I don't think they're selling their existing longer term. They're just not going to continue to allocate to the long end of the curve. I don't think they're purposely selling and realizing a loss just to buy in the middle of the curve. They'll be capturing lower yields. Lower yields, but also lower duration. The belief on this is that, and I think we're done with this chart that I drew out in here, so let's get rid of this. The belief on this, the reason you'd want to avoid the long end is if they felt that yields were just not going to go anywhere, or that you would get I'll just draw a line here to separate money market from capital market. So we have rates that are elevated right now, and you have a curve that is somewhat upward sloping at this point, the 3 to the 10 month. Where's our 3 month? 4.34 to the 10 month is 4.4. So we do have some upward sloping part of the curve right now. And the 2 to the 10, we have 425 to 440. So it's upward sloping by 15 basis points. The belief is as these rates come down, money market rates will, the Fed funds rate is an overnight rate, and then your first money market rate is the 1 month, holds very close to the Fed funds rate. That as this comes down, the long end of the curve might not. You'll get something like this. You'll get a steeper curve without these yields coming down. So if we're looking for return on duration, it's going to happen in this space right here, which is going to be somewhere in the 3 to the 7 year part of the curve. If this is the belief, if the belief is that the 20 and 30 probably aren't coming down and may even go higher, if they go even higher, you're going to get an even steeper curve. This would actually lead to losses. This would actually lead to gains. That is the belief. So that is what they're doing. By the way, you say here, looking forward to L2 results and start L3 with you. When you get to level 3 in fixed income, there's one reading called yield curve strategies. That is where you get more insight into riding the curve, strategies for a static yield curve and strategies for a dynamic yield curve. And with that behind you, you probably would have been able to answer this question on your own. So a little bit of a preview for what you can expect in the fixed income section for level 3. Next one, can you please explain box spreads and when to use it and how to use it? Not very useful. Box spread might be better used if you expect a lot of volatility and you're doing it, you're moving into one, out of another, and you want to keep your margin requirements as low as possible by having two on at the same time. They're not very useful, but this is really how you set it up. They're called a box spread because if you look at calls, calls, and you look at puts, all right, here are all your different strike prices, is that you're taking a spread like this so that it draws out a box because you're using spreads at the same price. So for an example on NVIDIA, let's do a call and a put spread. You would sell a 130 call and buy a 140 call, sell the 140 put and buy the 130 put. So you have a spread on both of these that cancel each other out. This should basically have delta equal to 0. Your gamma would be equal to 0. Your vega would be everything would be equal to 0. You'd have really no exposure. So you really have a risk-free position. This trade would have cost $10.03 to do. It's a $10 spread. Would have cost $10.03. So if you did it, you're making $3 risk-free. But it costs you $5 to get done. So you actually lose $2. Another name for this is an alligator spread because it is in reference to an alligator eating up all your risk-free profit with the trading fees because you have 4 legs. You need 4 options to get this done. So your break even, this is at $1.25 an option. You might even be able to get down to 70 cents an option. And even if you do, it costs you $2.80 to put on a $3 spread, and you're still going to have to hold $460 of premium against this thing. Or not premium, $460 of margin against this thing. Not until you get to like 10, if the spread were $10.10, then this pays $100. This pays $10. If it costs you $5 to do, you make $5 free. Try to do 1 million of these because they're risk-free. Do as many as your broker will let you do, right? But you're not going to find that. This will be arbed away to the point that any premium left, your transaction costs will totally eat away any premium left, and you're almost guaranteed to lose money. This is as a trade itself, as a profitable trade, it's not really. It's maybe at a large institutional level, if there's a 1 cent or 2 cent arbitrage opportunity, and you need very liquid options to get this done. You're not going to do it for 7 options. It's not really worth it, or seven groups of contracts. You're trying to do 2,000, 3,000, 4,000 at a time. While on very liquid stocks, you're just simply not going to find this. But that's what a box spread is for. I assume you meant spread and not a box trade. A box trade is something completely different. That means you are long and you are short the exact same underlying, such that any change in price would result in no change in value. And this is very useful. A box trade is very useful for transporting money from one account to another account without actually transporting the money, creating a loss in one account and creating a gain in another account. So I want you to think about having a registered account and you're approaching retirement. When you take this out, all this money comes out as income, and then you have another taxable account over here. What you'd like to do is transfer the money from this registered account to this taxable account as a capital gain and not as income. And the way you would do it is you would go long some stock in your registered account that you think is a loser. You want to go long a loser, and in your taxable account, you want to go short the loser, or create some kind of short position on the loser, maybe a synthetic on the loser. And if you're right, this will lose value and this will gain value. Your total wealth will remain unchanged, right? But as you're gaining value, you're creating a capital gain over here, and you're draining this account, but you're not losing anything. So you avoid the income tax of taking money out of your registered account, and it shows up in your taxable account, and you'll pay a capital gain. This in Canada is illegal. All right, if you're going to do this, you're going to need two different brokers. To get this done, where your registered accounts are with one broker and your taxable account is with another broker. If you're really successful at doing this and you drain your registered accounts, you'll be audited. You'll be audited. So you can only do it for so much. There's no law against being stupid, but there is a law against breaking the law, which is the law. You can't do a box trade. But some countries allow box trades. The U.S. allows box trades. The box trade, by the way, was a big deal in the .com era. That was a big strategy that was used in the .com era to protect founders from losing their money. So you had an IPO and you had a founder. Right, and most of these companies, they all went away, but you had a founder who might have had 5 million shares, and during the height of the .com, this might have been worth $1 billion, and you don't want to lose that $1 billion. So what you do, these are restricted, by the way. You can't really do much. Is you find a broker that's willing to short $1 billion worth of your stock, and you pledge your restricted shares as collateral against the short position. So you are, in essence, short what you are long. You are long restricted stock, which you cannot sell, but your broker will, if you find a friendly broker, they'll short $1 billion or as many shares as they can outside, so that if the price starts falling, you don't care if you can't sell it. You're making money on the short side. So there were CEOs that were arranging the short of their very own stock. Funny, eh? Okay, next question. Swiss central bank lowered its interest rate, maybe harder than expected. They went 50 basis points, and so did Canada. Can you dive into why this is, and if this means other countries might follow suit? Well, Canada did. From my basic understanding, this might be due to deflationary fears. There you go. Is Switzerland the only place experiencing this threat? Absolutely not. It is becoming more of a global thing. Japan's been there for years. China's starting to see it. Canada's beginning to see it. The CPI month over month from Canada that was released yesterday showed negative. So deflation month over month. And the inflationary pressure was under 2%, which is odd considering the exchange rate. The Canadian dollar has weakened significantly, which would make imports far more expensive, and all we can squeeze out in Canada is 1.9% inflation. That should have been inflationary on its own. So you can imagine, if the Canadian dollar had not weakened, how much lower the read would have been. This is a trend across the world for a number of reasons. You have slowing growth. The U.S. has been financing most of its growth with government deficits, and that's what's sort of keeping things up. But the backdrop of the global economy is deflationary because technology is deflationary, and our world and most of our lives are becoming more and more and more digital, more technology driven. And technology, as I said, is deflationary. Let's just have a look at, before we break this chart down, let me show you, we'll look at a couple of countries here. This is Japan. This is the zero line over here. And let's go to 1990 when the property bubble burst, and look at all the deflation. Look at how many times they've been below the zero line. Look at that. That is a suboptimal trap that is difficult to get out of. And another way of looking at deflation, because we don't think very well in real terms. We think very well in nominal terms. I have $1 and $1 buys so much. If prices go down, you think, but your dollar can buy more. Wouldn't you just buy more stuff? Not if they're big ticket items, because let's say that you're thinking of buying a vehicle or buying a house and you're seeing prices drop and they've been dropping for a while. You think, well, if I hold on a little bit longer, maybe that house will drop from 480,000 to 460,000. Maybe home prices will drop even more. Maybe car prices will drop. Maybe furniture prices will drop. Maybe goods prices will drop. Services costs will drop. So you end up holding more of your money. I don't know if that would be entirely true in the US because they have such a high marginal propensity to consume. Flip it around and say, well, instead of having a nominal dollar and thinking about what the real value of that dollar is, imagine you had a real dollar, which would not, in other words, you're not having to figure out the purchasing power of your dollar. You're just looking at the value of the dollar, and you're seeing that the dollar you're holding is now worth $1, $2, $4, $7. So every dollar you have is going up in value. You think, well, I should go spend it now. I say, well, no, maybe it'll go higher. See, that's the other side of it. If you think about it in terms of, well, I see the value of my dollar going up. Some people can do the math. They see prices going down. They can think in real terms, but most people think in nominal. But look at all that deflation. Can't have that. Look at Canada. This is Canada. You can see throughout from 2010 to 2020, look at the number of times the inflation rate dipped below zero and just tried to get above 1%, but right back down to below zero. Now let's look at the U.S. And go back to the 70s where there was a lot of inflation. Inflation generally is like, you can think about the natural flow of a river. What slows down the natural flow of a river? An impediment. That's usually the big driver of inflation, is there is some impediment to the natural flow of capitalism, and it's usually a supply constraint. Here's the OPEC supply shock. That is what did this and caused this recession here. And as soon as that was over, look how quickly it came down. And then you had the Iranian Revolution. You had like a double recession here because Volcker came in and crushed the economy at this point, saying we need to kill inflation. But both of these things led to supply issues. Not only that, the economy was far more sensitive to changes in energy prices back then because GDP was much more energy intensive. So when you have your economy that's really energy intensive, an energy shock can rip through the entire economy. It's not really the case today. GDP, especially in the US, is not that energy intensive. We have a more service-based economy, and like production is less energy intensive. And it wasn't until about the mid-'80s that technology really started to accelerate. Personal computers showed up in the late 70s, early 80s. By mid-80s, it started to become ubiquitous. By the 90s, they were in quite a few households. Early 90s, the internet started to appear. By mid-90s, there it was. Late 90s, .com. And it just continued on. So you have, look at this step-down function in the PCE. If you look at where the peaks are in the PC, you have this big step-down function. And what do we have here? The same kind of pattern that we have here. This pattern always is a result of supply. Demand-driven inflation looks like this. Looks like this kind of thing right here. Right? It is slow and over time because demand doesn't shock. Supply shocks, but demand doesn't. So you get this sort of thing going on. And then if you get a supply constraint, it shoots up. That is the footmark of a supply constraint. That is an impediment to the natural flow of capitalism. The natural flow of very technology-driven capitalism right now that will be more so in the future. You're going to see here, you can't really see it, but there were a couple of bouts of disinflation in around 2015. I think you're going to see this come down, and you're going to have this kind of problem that the rest of the world is having, fighting with the zero line. On inflation, you're going to be looking at the threat of deflation. I think it's inevitable that central banks around the world head to the zero line unless you stop the pace of technology and try to make the world a more expensive place to live in. That's going to be tough. Maybe one country can attempt to do that, but the rest of the world will benefit as a result. Switzerland the only place? No. Also, what this mean long term? We normally hear about higher rates for longer. Yeah, I think that is wrong. I think the world is suffering from a information processing bias called the recency effect. Is we tend to overweight the probabilities of events that we can easily recall. That we think about all this inflation, and we're forgetting, hang on, we shut down the global economy and then tried to reopen it thinking everything would just open at 9 a.m. on Monday morning, perfectly fine, and everybody would be on the same page. There were supply constraints. You couldn't get certain things, not for lack of trying, you just couldn't get certain things. It didn't help that governments then flooded markets with a whole bunch of easy money for everybody to stay home. That sort of exacerbated the problem, but I don't think the government transfer payments to households was the inflationary catalyst. The supply constraint was the inflationary catalyst, and then all you did was pour salt in the wound. It just took longer to heal. And you still have the U.S. running, 6% deficits to GDP, and most of this primarily is in transfer payments to the consumer and to businesses, making it appear that the C and the I are healthy, but they are not. So yeah, if you also start cutting back on the fiscal deficit while you let the pace of technology continue onwards, deflation. So I disagree highly with the higher rates for longer. Or might this actually mean we go back to low rates like we have experienced before COVID? I think that's where we're headed. I just going to take a while for everyone else to figure it out, but I do think that that's where we're headed. Okay, I hope you see this. I've been watching the Applied Top-Down series over the past week. I've been summarizing the indicators to draw a conclusion based on what has happened since 2022. Can we conclude that we experience a soft landing in 2022? I say somewhat yes. Because I think we experienced a slowdown and softness in the economy, but I don't know that we landed. I think that it was a no landing thing. It was just, there was a period of softness and then off we went. It wasn't necessarily a positive outcome. There I have a question about your definition of that. What do you mean by it wasn't a positive outcome? Positive in what sense is what I would say. Was positive for employment, positive for company earnings. It was positive for the stock market. It was positive for the economy. Unless you think, well, sure, you can have candy now, but you're going to get a toothache later. I guess my question would be, well, what is the negative part? If it wasn't necessarily positive, what was the negative part? It seems we're now heading straight into a recession. I have a problem with that statement because to get there, we need a catalyst. What catalyst? Endogenous recessions are extremely rare. And an endogenous recession is the consumer just is tired of spending money. Everything's getting too expensive. Everyone's staying at home. That for the U.S., that is not a very good argument at all. I can't think of any time there's been an endogenously led recession. There's always been some exogenous shock. So if you say we're heading straight into a recession, that seems pretty deterministic. I would say, well, what catalyst are you suggesting is going to cause that? And it's usually a few things. There's usually some geopolitical event that causes supply constraints, very significant supply constraints globally. There is a supply shock, or there is some financial crisis. Where is the financial crisis going to come from? We did have Silicon Valley Bank a little while back, a year and a half, 2 years ago. I can't quite remember the date. I think it was like a year and a half ago. You had Silicon Valley Bank, but look how quickly the Federal Reserve moved in, how fast they moved in to take care of that. It was a blip. So what financial crisis could unfold that the Treasury and the central bank would not immediately respond to very, very fast, right? You got to give me a catalyst for this. Seems we're now heading straight into a recession according to most indicators. Well, there we got to stop again. Are they still valid with government transfer payments being 6% of GDP? So government spending, the actual government spending, if you think about C plus I plus G plus X minus M, we have, the U.S. has a budget somewhere around, let's say it's $6.8 billion. Government spending is about 1.9. That's actual direct spending. The rest are transfer payments, Social Security, things like that. So a large part of the money that is spent in the budget is given away either to consumers or to businesses. Think about the CHIPS Act, right? Think about the Inflation Reduction Act. It's transfer payments to C&I. So if you have transfer payments that are basically almost 100% of real GDP growth, what indicators would still be valid in the face of a government buying all of the growth? So let's say that you are renting an apartment from me, and I can see you're around the building all day long. You're home. You don't have a job. All the indicators, that's a big indicator for me that says you don't have the cash flow to pay your rent, but what if your parents are paying for it? Then that indicator is of no value to me. It's usually a fairly good indicator that when I see my tenants hanging around the building all day long, it's not long before they have to move out because they can't continue to pay the rent. You have the same footprints, but your Uncle Sam is paying all the bills. So the indicators don't mean anything to me. So according to most indicators, are they still valid when government transfer payments are 6% of GDP? Other factors such as forward PEs and the exhaustion of buying power in the market also support this theory. I'll agree with you with the forward PEs. It seems difficult to justify a forward multiple of 23 times forward earnings without the expectation of significant growth from here. We're already running real GDP of 3%. Which means we'd have to have some expectation that that is going to increase from here for earnings to increase from here. But if we have a Treasury Secretary coming in and more conversation about getting the budget deficit from 6% of GDP down to 3% of GDP, and if this has been providing all of the funding for the 3% GDP growth and you want to cut it, where's the growth going to come from to justify the 23, right? I agree with you there. I think that is way overextended. A hard landing might not only be inevitable, but also could be the most effective way to stabilize the market. Well, maybe just a correction. I don't know that you need the economy to contract to get the stock market to correct. I mean, if you get a correction down to 20 times, that would be some 600 points off the 250, about 750 points off of a 6,000 point market. That is 12.5% correction, right? That might be okay. Problem with corrections today is you have a market that does this and then it corrects. And then you get this V-shaped recovery and it just continues on. It's like, well, we corrected down to something more reasonable. We should grow whatever rate this was, we should grow. But you end up with these V-shaped recoveries, and within a couple of weeks, you're right back where you left off saying, well, that was the correction. Yeah, but it's not a correction if you repeat the same mistake. Right now we're back up here and saying, well, here we are again, overvalued. When we correct, we should be correcting to a new level and growing from a new level, not just saying, okay, there's your 10%, let's get back to where we were. But last 4 or 5 years, every correction we have is just V-shaped. You just say, okay, well, there we are. It's almost like running to the other side of the gym, touching the wall and coming back. The important thing is I touched the other side of the wall. And well, you know, in a correction, you're supposed to stay on the other side of the gym. The market doesn't do that. How worried are you about a bear steepener in the yield curve? Well, we've already been getting that. This is the yield curve week over week. This is the most recent week. This is as of last Friday. This is the Friday before. And there you go. That's when we say steepener. When we say bearish, what we mean are yields going up because bond prices go down. So when you see the yield curve move up, that's a bearish move because bond prices drop. When we say steepener, it's the 10-year yield minus the 2-year yield increasing. And right now we're at 15 basis points. So the thinking is, well, as the Fed cuts rates, money market rates will respond in kind. We're already seeing this happen, is that you might get money market rates doing this, and then you get a curve that does this. So it goes even higher on the yields, but the 2-year to the 10-year gets steeper. So that would be a steepener, and that would be bearish, just in case you're not familiar with the terminology for bear steepener. It is 2 words. The first one is bear. As soon as you hear bear, you think yields up, prices down. That's bearish. And steepener is, a curve from going from this to this, right? How worried am I about it? Well, I mean, it's, I have to ask myself, is a bear steepener in reaction to data we're looking at today without any consideration of the future? Or is it because a belief in the future is changing? Now, I think that the belief in the future is data driven by what we see today. That we're only playing out one side of the equation, which is we're seeing that inflation is not going down. So we're overweighting the probability that we're going to have elevated inflation, even though the 30-year record almost globally shows that we are in a deflationary backdrop. And I think we're underweighting that. So I'm not worried that a bear steepener is the true case a year from now. But you do have to worry that the belief of a bear steepener is going to cause you some short-term pain in your portfolio. I think that's more of my concern, is how long am I going to have to sit on a losing position before the market figures it out. Let's see. One way this could happen, in my view, is as Trump takes over, spending continues to rise and U.S. debt keeps peaking. Interest on debt skyrockets. I don't know if I would say skyrockets. I'd say it increases. Confidence in U.S. falls at the same time as BRICS countries rise in prominence. If you get more spending, if spending continues to rise, real GDP will continue to rise, because most of government spending is in transfers. So if those transfer payments continue, if you get tax cuts, you're leaving consumers with more money, you're leaving businesses with more money. If you don't cut the transfer payments to the consumer, then their incomes aren't dropping, but their wealth is rising because of lower taxes. You will get growth. So when we say confidence in the U.S. falls, confidence in their growth or confidence in their debt? Higher debt is not the cause of a debt crisis. Debt crises never happen because you have too much debt. Debt crises happens when people believe they won't be paid back. So if there's a belief globally that the U.S. is not going to pay them back, then yes, that is going to be a big problem, and investors will lose confidence in U.S. bonds. If it's just a matter of there's a lot of debt, that's not the conditions for a crisis. It might be the conditions for ever creeping or yields creeping ever higher, but it's not the condition for a loss of confidence in a crisis. So I wouldn't look to that. At the same time, BRICS countries rise in prominence. Investors will demand higher bond yields to invest in bonds. Longer term yields rise, TLT drops. Yeah, that is a scenario. You could have that. But fundamentals have a nasty way of showing up, right? They show up all the time. So if you think about investor psychology and what they believe is going to happen, there is a report card for what actually does happen. Now, if there is a loss of confidence in the U.S., it's going to come from growth, not from the level of debt. So the way I see it playing out badly for me on duration is they cut taxes and they follow through on their other promise to raise tariffs and to reduce the deficit. And growth in the U.S. begins to drop. And The rest of the world right now is lowering rates, so they become a cheaper place for investment, really, and their markets are trading at multiples way below the U.S., so they also become a better place for investment. That could elevate the long end of the curve for a longer period of time if they start doing this and the world says, you know what, we're not going to bend the knee. We're going to go our own way. So far, everyone's traveled to King's Landing, which is Mar-a-Lago, and they have bended the knee. And not only bended the knee, but paid tribute. How many people are showing up saying, here's $1 million for your inaugural campaign. Here's some money. It's happening right now, but you can only threaten to punch people in the face for so long before some people say, you know what, screw you. And then other people say, oh, he stood up against the king? I guess I can stand up against the king. And then that's how it would start. But I think if you're looking for lost confidence leading to higher yields, look at growth. As soon as the world starts losing confidence in the growth story, then at that point, I think my TLT trade might be in trouble. However, you'll have a central bank that says we need to get rates down. And down they will come, and you may end up with a steeper curve, but keep in mind that's 380, 360. You'd have to go all the way down here to get to zero. You might still end up with a very steep curve, steeper than this, but with long yields still much lower. You still have a central bank, right? Seeing Mag 7 go up each day, and Tesla just running a marathon, it hurts having stocks like NextEra, GMT in the portfolio. Yeah. I'm sure that day I buy, they will start going down. Yeah, just bought NVIDIA 1 week back. Yeah, and that's not been having a good time lately. Although today, let me just slide over here. Let's have a look at NVIDIA. NVIDIA is at 135, up 3.5% today. And whereas Tesla, I think Tesla's having a tough day. Oh, no. For some reason, they were down like $14. Now they're up 8. That is a wild ride. My question is how to stay calm and focused when you see Tesla go up almost 5% each day. Oh, well, you can buy some Tesla. There's nothing wrong with buying Tesla. Understand that there is a measure of intrinsic value in Tesla, which shows up every 3 months, but Musk is very good at getting people to look at the horizon. Don't look at today, look at tomorrow. All of these things are going to happen. All of these things are coming, and to keep telling you what's on the horizon. He's been doing that for years, and sometimes he can keep it going 4 or 5 years, 6 years before he has to deliver anything. So the belief is that President Musk or co-president Musk is going to change the regulatory landscape to benefit him. The feedback so far from full self-driving is not that technology, not that regulation has been holding him back. It's that it doesn't work. So the worst outcome for Tesla is you get rid of all of that regulation, and he can start selling it as full self-driving, and you continue to get the body counts racking up. I don't know what their body count is at now, 19, 20, 21 dead. But all you need is a couple more high-profile dead people using full self-driving. That is the worst thing that could happen to Tesla. So, I would caution the exuberance on this, the idea that the only thing holding them back was all the regulation, and all the Teslas could have been driving themselves. No, it's not regulation. It's that it really doesn't work. It may work in 95% of the average everyday use cases, but that's not what matters. That's not where accidents happen. Accidents happen in the edge cases, right? And so you can't just look at, well, we drive all these miles without accidents. It's like, but you have to look at where in what times of day accidents occur and how many have occurred during those periods of time. The numbers aren't that good. But I get what you're saying. You're seeing all of this stuff move, and you're thinking, well, my stuff isn't. However, GM did go from $28 to $60 in 1 year, right? Let's not forget that it had its day. AT&T went from 16 to 24 in a period, I think, of 6 months. Nextera went from under 70 to over 80 in a period of 6 months as well. They had their day. Keep in mind that Tesla at one point was $400, fell to low 100s. So, what goes up goes down. What goes down goes up. Everything has its day. If you're looking at the board and you're saying, I'm in things that aren't moving, you end up chasing momentum around the board. You will do worse than if you just stand in one place. So it could be that, you were in stocks that had their day. They were in favor for a while, and then they're out of favor, and now some things are in favor, and then they'll be out of favor, and then some other things will be in favor, and then they'll be out of favor, and on and on and on we go. If you, I don't know that I would stare at Tesla. I would think, okay, what you want is exposure to the momentum factor. Well, there are ways to find momentum and to trade momentum, but make sure that's what you're playing, because there is momentum and then there is volatility. Volatility can look like momentum that's really not going anywhere or not intended to go anywhere. So make sure you know what you're playing. Momentum is a directional play. Volatility is a non-directional play, but still extremely profitable. Both of those are really good trades to make. If you have the applied level in the portfolio construction, I did show you how to find momentum. There are a number of ways to find momentum, and momentum usually hangs around for a while until it doesn't, right? Momentum is your friend until the end. Playing volatility, I've been showing you how to do that using MSTR and MSTR and IBIT. This week I'll be expanding that to Riot and Mara, showing you how to use the volatility of these things, not the direction, but the volatility of these things. You plan to do a sector studies for AI. I don't think that AI is going to be the exciting thing. Bitcoin miners are starting to get attention from the convertible bond issuance. And I think that is an exciting thing, not because I believe in Bitcoin, but just because of the economics of what they do. Their assets are operational assets. That's a different thing than MicroStrategy, whose assets are primarily financial assets, which means the miners can trade at multiples of their net asset value because they are investing in operational assets, which are the miners, as opposed to just having financial assets. So this is if supply they are the suppliers of Bitcoin, right? The global Bitcoin rate, supply rate, is 18.5 Bitcoin per hour. That is how many new Bitcoin are mined per hour. And because they use this to pay for their operations, they sell the Bitcoin into the market to increase the supply. But they are now using convertible bond issues to finance their operations and holding on to supply. And more of them are starting to do that. That is a supply-demand dynamic you can't ignore. So I think a nice trade has three legs. You're going to be short a low beta source, you're going to be long a high beta source, and you're going to benchmark your volatility to some delta. And you combine that all into, if I could create a packaged product, an ETF that had that in there, where you were short low beta and long high beta, such that you were beta neutral, you have a source of alpha plus volatility in here. Your long high beta is coming from whatever it is that you're benchmarking to the delta, and you have some source of negative beta, so that you try to be as beta neutral as possible with volatility. Now you have no market exposure in that thing at all. You simply have alpha and volatility, which is a beautiful trade. I'll be introducing that in the applied level over the next few weeks, but you should already be familiar with the trade setup, the volatility trade setup, and you should already be familiar with benchmarking to a delta. we're basically going to play the same game as the convertible bond holders are without the call. So there are many ways to get involved without saying I'm going to buy 200 shares of Tesla and hope that the price keeps going up when it is got a report card, a fundamental report card every 3 months. There are better ways to play momentum, smarter ways to play momentum. And when you do find momentum, distinguishing if am I playing momentum here or am I playing volatility, because you would use two different strategies for those. Okay, number one, 2 questions here. An opinion for the applied videos position updates. Would be better if you can incorporate a chart with your entry and exits marked on it, along with screen writing, just more intuitive. I can try this, but most of what I'm doing has options involved. Although the trades I've been doing lately, yeah, I guess I could put that in. With options, it's rather difficult because if you're moving in and out of the options, I guess I could use option charts. I guess I could do that. Could you do a walkthrough of your daily routine? It'll guide us of what it takes to move ahead in this career. The more detailed, the better. More detailed. So I've been thinking about this and what I could do for this. In Costa Rica, I have a fairly large house. If I compare it to my Canadian home, which is fairly large, my Canadian home would fit right about here in that house. I was thinking that what I could do is do weekly live sessions where you actually show up, because there's plenty of rooms in this house. Is you actually show up and stay on site for a week. There's another room over here that has a large screen and can be set up as a boardroom. And we could just be in here. Rather than me describe my day, you can live my day for 4 days during the week. You would do exactly as I do, and then it would be, I think, fun to have the early morning meetings, because I sort of have those meetings in my head with myself. So it's just a matter of getting you down here and in the place for a week. And then, of course, you can turn it into a vacation, because if there's you can bring your significant other, right? And all the other significant others can do all sorts of things in the area. There's lots of great places to go. And then we would just spend Monday through Thursday doing that, right? So it's just a matter of, well, what does that cost to get done? Because it's not free for me doing this kind of stuff. I just haven't got an idea of what that would be. If any of you would be interested in doing that, I don't even know if there would be interest in that. But if any of you would be interested in doing that, let me know. Just put a comment in the in the comments section. If it's something that looks interesting, I'll try to design something. Let's see. Final seasons for the first semester has just wrapped up. This is the second part of a comment. I am a student. Was the first part on that final note. Final seasons for the first semester has just wrapped up. You have said before you believe education will be, or has the potential to be, disrupted significantly over the coming years. Absolutely. I absolutely believe that, because it is an outdated model. 4 years for an undergrad, and the faith in higher education has never been lower. They've really fumbled the ball with all this woke shit and DEI shit they did over the years, and sort of put free thinking and exploration to the back seat, and put feelings and risking hurting feelings to the front seat. And you can't say this and you can't say that and you can't do this anymore and you can't learn this theory or that theory. They've really shot themselves in the foot. I mean, if you want to expose how useless a business model is, higher education. I completely agree. I'd say I'm constantly underwhelmed with the quality of teaching and education that I get. Well, one thing that you have to understand, especially in business schools, is business schools don't hire practitioners. They don't even hire teachers. They hire researchers, right? That's the idea behind being hired by a university. Is your PhD is a doctor of philosophy, primarily philosophy of knowledge. And your task is to create new knowledge, which is why you're trained in the philosophy of knowledge. Is, well, what is knowledge to begin with? If I'm going to create it, I should know what the hell the definition of it is. And there's no real definition. There's just different schools of thought, different philosophies of what it is. And then you publish. That is who they hire. It is a publisher paradigm, a publisher parish paradigm. If you don't like academic research, and it is boring and pedantic, I'll tell you it is a colossal waste of time, a waste of everybody's time, is academic publishing. If I had a choice between ridding the world of cryptocurrency, which I think is a colossal waste of money, or ridding the world of academic research, it would probably be academic research, especially in the social sciences. Maybe not so much in the hard sciences, but the social sciences, give me a break. That is, it's more creative writing than anything else. It's all bullshit. It's all bullshit. But you got to do it. So yeah, if you think the quality of education sucks, it's because to be in a business school, you need never have set foot in a real business in your life. And all you do is you research. You're a good researcher. You're a terrible teacher. You know nothing of the real world. Come on in. I mean, to teach in a law school, you got to be a lawyer. To teach in the engineering school, you got to be an engineer. Teach in a dental school, you got to be a dentist. Teach in a business school, you need never in your life have set foot in a real business. You want to be a finance professor? There is no requirement that you ever have traded a single security in your whole life. This is the problem with this type of education. I know this is highly variable from school to school, but it seems like a growing trend of treatment as a customer rather than a student. Yeah, well, you're a customer being treated like a student. I don't know that so much that I'd say a customer model, because I don't know that customer service really matters, or that customer engagement really matters. I am all for access to education, but a growing population of less engaged and less prepared students dilute and hold back the quality and depth. The big misunderstanding is that higher education, it should not be called higher education, by the way, because that suggests that they're in the business of education, and they are not. It should be called, and rather we should call them institutes of higher certification, because they're in the business of certification, not education. You choose a school because you want the degree from that school. The education across a whole bunch of schools is almost equal, really. Most of them are using the same case studies. Most of them are using the same textbooks. There's a wide range in the quality of the professor. But if you take the top 50 schools in the U.S., the quality of the education is pretty much the same. You're paying for the certification. You're paying for that degree. Education, the knowledge, is basically free. It's the certification that costs money. So they should be called institutes of higher certification. You can get education anywhere. I think there should be a separation between education and certification. And for certification, why is there one? Why do I have to take a 4-year degree to get a business degree, a BCom, for example? Why do I need a BCom, for example, when this could be broken down into maybe 20 different micro certifications? What do I need a class in HR if I'm a finance major? I really don't care about a class in HR. And if you ever want to find a new stage to hell that Dante missed completely, it's called Introduction to HR. It is a new stage of hell. I'm surprised that somebody hasn't rewritten Dante's Inferno to include that as a new stage of hell, because that's in there. Why do I need to take this monolithic 4-year degree? be out of the job market for 4 years, incur fees for 4 years, have parents pay for 4 years of this stuff, when I could take micro designations and I can take them at a distance. I mean, if you really think that work from home is a thing, then study from home has to be a thing, because a demonstrated ability to work from home is a demonstrated ability to learn from home. Why not include that in? But you separate education from certification. This part is almost free. This part, okay, that has the price, but let's be clear about what you're paying for. You're paying for the certification. Get your education anywhere, and maybe this is an exam where Harvard, a business school, says, okay, well, we have a certain standard. If you feel you've lived up to that standard, here's the exam. And if you pass the exam, you want this credit, okay, that is $12,000. Well, there's your business model. Like, you know, be in the business of what you're in the business for, but I think there should be a separation between the two. I am, by the way, working on the foundations of a business model for a startup on this, of which I am willing to put significant funding behind. If anyone out there is interested, anybody significant, by the way, who can come heavy, is interested in making an equal investment, I'm more than happy to explain what I have in mind, having spent my whole life in higher education. Let's say this is the lecture hall, there's the professor, here's the classroom. On one side or the other, I've spent my whole life in the education system. I know what a complete waste it is. I know where the value of it is, and the value is in two places. It's in the education and it's in the certification, and I think there should be a separation between the two. Okay, last question. It is on the crypto side. I'm pretty much almost done discussing the crypto stuff. I am a crypto skeptic, but I'm having a hard time getting on board with your viewpoints, because it sounds incredibly subjective to what your current comfort level of central entity scrutiny is. There are numerous times when the government has taken their taxation to confiscatory levels, like Argentina. Well, now we're talking about taxation. This is an illegal act to avoid taxation, to try to defraud tax authorities. I mean, in Canada, I was facing 53.5%, which in my mind was a 40% tax rate and a 13.5% confiscation rate. But Bitcoin does nothing to avoid taxes at all. So I guess my question would be, you know, how does Bitcoin or any of the cryptos avoid taxation? And in attempting to avoid taxation, is this not illegal? And if it is, and if there is a way, does this not support my argument that this whole crypto space is really there to help facilitate crime? I can understand that taxation is unfair. I had unfair taxation, but it's still a law. And for me to avoid the 53.5%, I would have to go out of my way to break that law. And I'm not willing to do that, because I like my freedom. Up here, plain and simple. I like my freedom, so I'm not about to do that shit. I don't know how this would be any different. Maybe a different level. And if you have a country that is willing to actually confiscate real property, physical property, what makes you think that they're going to stop there? I mean, to me, it seems simple enough. You just take a North Korea approach and shut off the internet. If I shut off the internet in your country, where's all your Bitcoin? Where is all this stuff? Because that's where it lives. You need that connection. If I'm really that type of government where I'm confiscating things, if I really wanted to confiscate, that would be the first thing I would do, is shut off the internet, except for one computer at the local police station in every city. And I would offer my citizens one opportunity to repatriate their Bitcoin for a 50% penalty or lose it all. I mean, if you're really afraid of your government, what's stopping them from doing that, right? Anyways, avoiding taxation with crypto is illegal. That is illegal. So if that's what it's used for, I would have to add yet another illegal activity to the list of illegal activities that this thing seems to support. What would be your objective argument? I like the second paragraph better, really. What would be your objective argument against crypto or decentralization of finance in general for those of us who are not criminals and simply not comfortable with the size and growing invasive nature of not just the U.S. government, but governments around the world? I am not quite sure how the existence of the crypto space can help you there. In most advanced countries, there are exit taxes, and putting money into crypto is not going to help you because there is a record of it going in there. You can't, money can't just disappear. There's this, you have to report, you have to report the movement of it, and you'll get audited. So let's just say that this is, if you're going to do that, if you're going to try to avoid this kind of stuff, you're doing it in the dark. But let's just see if I can come up with an argument against the decentralization of finance in the way that, let's say, and we'll use Bitcoin, the more popular one, in the way that it's being done right now. Number one is the inevitable unsustainability of mining. If you look at the economics of mining and the structure of the creation of new Bitcoin, it is structured such that each block will take about 10 minutes. So the more miners you throw at the problem, the more sophisticated your hardware becomes. And it has become more sophisticated, moving from CPUs to ASICs, and moving from 110 nanometer down to 7 nanometer now. The more you throw at it, the harder the problem to solve becomes. The algorithm, the difficulty adjustment increases such that it will take on average about 10 minutes to solve that problem. Well, as the problem becomes more and more difficult, the energy consumption becomes bigger and bigger and bigger. All of Bitcoin mining in the last year has used more electricity than the Philippines for a year. More electricity than the Philippines. Just to give you an idea, the last paper I read, I think, was from Yale, talking about the economics of the energy required in this. That if you had all of global trade transacted in Bitcoin, the energy requirement would exceed the current GDP of the world. Just for the energy to get it done would exceed the energy of the world. So as you have these miners becoming more sophisticated, becoming more powerful, and you have more of them coming in, because as the price of Bitcoin rises, what happens is the marginal cost of production rises to the price of Bitcoin because you have more miners come in, and the difficulty adjustment adjusts the algorithm such that the problem to solve becomes that much more difficult. So you need more leading zeros, right? Because if you have a certain space, the way you solve a problem is you have to generate a hash which is less than some minimum number. Well, that usually starts with leading zeros. The more computers trying to solve the problem, the lower this gets. And it's a brute force algorithm. It's not an elegant algorithm either. It's brute force. The energy required is off the charts. So there is an inevitable unsustainability of mining. At some point, it doesn't. The cost of trust doesn't justify it anymore. And this is non-scalable trust. Which means the cost can only increase over time. What do I mean non-scalable trust? This is peer-to-peer, so it does not rely on a trusted third party. let's get rid of the word trusted, because let's just say third party, because it seems to me kind of oxymoronic in the sense that you require a trusted third party to access a system which does not require a trusted third party, right? All of your exchanges you use to get your fiat currency into a coin. And I think Binance now, their CEO's out of jail, right? So that's run by an ex-con. This is your trusted third parties. So what I mean by the scalability of trust is, let's say you have a conventional system where you have the rule of law, you have courts, you have prison, right? You have all of these things in place, and then you have some security built into the system, and you add another user into here. Well, there's no incremental cost. You add another user, another transaction, another contract. Once you have laws and courts in place, you can layer on contract after contract after contract after contract, thousands and thousands of transactions by contract, and the cost of that trust doesn't change, but it does keep increasing here. The cost of trust keeps increasing, so it's really expensive trust. To have a no-trust system is super expensive trust. So there's this inevitable unsustainability of the mining. And then there's the inevitable increasing cost to users. The idea that you can transfer Bitcoin from one user to another user without an intermediary so that there is no cost, that is not true. If there is no cost, your transaction, all these transactions go into something called the mempool. And then you have a whole bunch of these in this pool. And then a block will have a whole bunch of transactions, somewhere between 1,000 and 2,000 transactions, and they're chosen from the mempool. But they'll be chosen in order of profitability. The larger the transaction fee that you put in there, the more likely your transaction will be included in the next block. If you don't include any transaction fee, it could be weeks even with your transaction not being approved. As this halving event occurs, the amount of Bitcoin that a miner gets for adding a block gets halved about every 4 years. As that occurs, what you have is, and I'll draw this out for you, and this is an unsustainable path as well, is you have a certain amount of revenue that must be earned. Well, as the reward for mining the blocks decreases, the transaction fees have to increase. So over time, users will have to add more transaction fees and more electricity will be used. That is one super expensive trust system. If the US moved all to Bitcoin and all the Bitcoin mining happened in the US, some estimates are that about 60% of GDP would be required just to run the network. That's unsustainable. That is an extremely energy inefficient form of GDP. Now, there are use cases out there. There are use cases, but they are too small to justify a $2 trillion market cap. Without the developed world's level of speculation in this asset, this whole thing fails for legitimate use simply because the cost of trust is too high. So that's the big problem I have with this is it is a one-way ticket on the costs. Now, there are other more malicious things going on as well. Is who is paying for these mining costs? You may say, well, it is the miner that's paying for it. Let's be careful. Sometimes the miners make money by selling their contract electricity back to the grid in times of higher electricity usage or higher electricity costs. But you wouldn't have those higher electricity costs if the utility didn't give away a lot of its capacity to the miners. So you have not only a huge amount of energy being used to generate this, it's an extremely expensive form of trust. You also have a transfer of wealth from the household to the Bitcoin miner. The household pays for a lot of this. Now, if you have these use cases in these other countries, where there is a use case for it and you get rid of speculation, and all of the miners are in developed countries, the developed countries are paying for the level of trust in the network that the receivers are not paying for. It is still just a transfer of wealth from one part of the world to another part of the world. This is the big problem I have with the current, with Bitcoin. Ethereum is meant to solve that problem to some degree by having proof of stake instead of proof of work. But all of these proof of work systems, I think, are inevitably going to fail simply because of the unsustainability of mining. I think it is, there's an index you can look at. It's the Cambridge, what is it now? The Cambridge Index of Bitcoin electricity usage or something. There is an index. Give me a second. I might even have it up here. Here it is right here. The Cambridge Bitcoin Electricity Consumption Index, run by University of Cambridge. I'm going to say it again so that you have it. The Cambridge Bitcoin Electricity Consumption Index. I'm on it right now. It's updated every 24 hours. You can look at Bitcoin and Ethereum for what you want to look at. Greenhouse gas emissions, Bitcoin, last 24 hours, estimated annual 94.85 million tons of CO2. That's the best guess. 90, almost 100 million tons of CO2 for this imaginary currency. If we look at, let's just go right to the index itself. I'm just reading it off to you. Bitcoin network power demand, annualized estimated consumption, 183 terawatts. 183 terawatts. And again, that is more than all of the Philippines just for this imaginary currency, and you're only at the fourth halving. As you add more miners to the system, and more will come, as you add more of these machines, because these ASICs are still being produced and these machines are being sold and they're being added to the network. As the total hash rate of the network increases, the problems become harder. The electricity consumption goes straight up because you have to work even harder and harder. It's a one-way path to unsustainability. I would say it's unsustainable right now. 183 terawatts. Just to put it into global perspective, in 2023, Bitcoin mining, just Bitcoin mining, used 0.8% of the world's electricity. That's it. Just I shouldn't say that's it. At this point, what many are considering the very beginning of it all, really, we're still in the early stages. It's only the fourth halving, and you're already at 0.8 of the world's electricity, and it can only go in one direction, more. Again, let me read off that greenhouse gas emission so that you have it. 95 million metric tons of CO2 per year for this imaginary currency. Is that enough? This is a super expensive form of trust, a super expensive global form of trust. And if there are use cases in these other countries, then Bitcoin mining should be concentrated in these other countries so that they pay the cost of this, not developed countries paying the cost of this. Bitcoin miners just aren't profitable. They're if you look at their statements, they're really not profitable. So it is just those countries where the Bitcoin miners are financing it for everyone, financing the cost of this for everyone, that is in the end unsustainable. But you don't have to take my word for it. You can head right to Cambridge Bitcoin Electricity Consumption Index, and if you have questions, direct it to them.